Alright, welcome everybody to the JDC West 2016 tax case presentation. First off, I'd like to thank our judges. We have Kristen Haig from Potash Corp, Ashley Lund from Golden Healthcare Management, Irina Kovrenko from the University of Regina, Dave Nielsen from Collinsboro PQ LLP, and Jill Johnson from Cameco. Competitors will have a maximum of 20 minutes to present. Immediately following the presentation, judges will have a total of 5 minutes to ask the presenters questions. The volunteer timekeeper will show time cards at various intervals to indicate the remaining time and will stop any speaker who exceeds the maximum time limit. No questions, comments, cell phones, or picture taking will be permitted from the audience at any time. The audience will only be permitted to applaud following the question and answer period. The audience is banned from any material that bears the name or symbol of a competing university, and we ask that the audience exit the room immediately following the question and answer period. Competitors, you may now begin whenever you're ready.
Grace, good afternoon and welcome to our presentation. My name is Tommy and these are my colleagues Shan and Misha. My team and I are really impressed by what you've been able to achieve with Can Energy Corporation in the last 10 years. Now, we're also very excited to hear about your new opportunity of a new partnership at Econ. And so there's no better time than now for us to take a look at some of those tax implications on your decisions and help you minimize those taxes. Let's begin by taking a look at today's agenda. Today, we want to help you, we want to focus on helping you solve 3 of your key issues. First, we'll be taking a look at your current options, that is, whether you should stay at your current company as CEO or you should take the new partnership offer from Econ. We'll be taking a look at advantages and disadvantages with both options and show you the option that you should choose that will maximize your benefits in the future. Next, we'll be taking a look at the sale of your companies right now and show you how you can take advantage of the opportunities in the Income Tax Act to save $813,000 in capital gains. Finally, we'll be taking a look at some of your personal taxes and show you some of the allowances as well as deductions that you can use to further reduce your taxes. All of our recommendations today will ensure that you, as well as your business, achieve long-term excellence. Let's begin by taking a look at the current corporate structure. It's very simple. Grace, you currently own 100% of your company, Can Energy Corporation, and right now you have 2 options on the table. One, you can either continue expanding Can Energy Corporation and stay in as CEO, or you can accept the new partnership offer from Econ Incorporated. Now, let's take a deep dive into these options and take a look at some of the qualitative as well as quantitative reasons why you should choose either option. With the choice to continue in your current corporation, we think there are a couple reasons why you should do it. First, you can continue to do what you do best. You've been in this industry and you've been running this company for 10 years now, and it's successful because of your experience in this industry. So by continuing to running it, you'll be able to capitalize on all of those experiences. Next, we think one of the reasons why you've been so successful in this business is because of the loyal employees that you have in your firm. Now, depending on who you sell your company to or what their intentions may be, if you choose to sell it to them, the future of your employees at your current firm will be in jeopardy. So that is a factor that we do want to keep in mind. If you choose to continue to run your current company, you'll have flexibility in income. Because you are the sole owner, you'll be able to take out your income in either dividend and salary, and it'll give you some tax flexibilities on that. And finally, because your company is in Alberta, you're subject to a lower tax rate than if you move to Ontario. As for your other option, which is to take the new partnership offer at Econ, you will have a larger personal growth opportunity because you will have access to much larger contracts that you have at that firm. Next, you've mentioned to us that you're really tired of working 70, 80 hours a week, and with the move to the new company, your responsibilities at the firm will be shared by many other partners, and so it is likely that you will have a less time commitment to the new firm, allowing you to do more of the things that you enjoy. And finally, you have a higher tax rate in Ontario that we've previously mentioned. And with higher tax rate, you do get a higher income. Well, we've calculated some of the numbers and we've made some assumptions on how much bonus you would get from the new offer. But after taking into all the tax calculations, we think that choosing to go to take the partnership at Econ will result in much higher financial payout for you. Now, so in summary, accepting the new position at Econ is the better option of the two. But is there a third option? Is there a third option that will allow you to achieve the best of both worlds? And we think the answer to that question is a definite yes. That solution is to sell Can Energy to Econ. We think there are significant synergistic opportunities with this deal. First of all, to Econ, they've already expressed their interest in entering the Canadian, Western Canadian market. And if your company, Can Energy, can get those two contracts that you've previously talked about, we think your company will be a very attractive acquisition target to Econ. The question would be, are they able to afford your company at a valuation of $900,000? Given, now we don't have the financials of Econ, but given what we know about the company, they are very large and they're very resourceful. So they would, this option would easily be financially feasible to them. As for your company, Can Energy, the benefits to you would be that you can continue to operate with the experienced employees that you have, and because you're the most likely candidate to run this company after they have acquired it, your employees will be continued to managed and protected by you. And finally, you've mentioned there are significant opportunities for your company in the future, but it's going to require a significant amount of capital. By Econ acquiring your company, it will have access to all of those capital that the company needs to grow. So we think selling Can Energy to Econ will help you achieve the best of both worlds. And now I'll pass it on to Nimisha to show you how you can put that into action.
Thank you, Tony. So now, Grace, let's take a look at how you can sell your business. Now, there are two options you have here. You can sell either through assets or through shares. Selling through assets, now most of your company is built upon through contracts, and the value comes more from your intangible assets. So I would like to focus your attention more so on the shares. Selling through shares is a simpler process, and you're able to utilize your lifetime capital gains exemption. And what this means is you get tax-free capital gains of up to $813,000 if you are a qualified small business corporation, of which in case you are. So I would like to also say that selling through shares, you're also able to pass on your liabilities, so you do not have to worry about that. And so after considering that the ideal option for you is to sell through shares, the question then becomes, how much of the business to sell? Now, instead of selling 100% of the business, we recommend to sell 90% of Can Energy. This is because by selling 90% of the business, you are able to fully cover those tax liabilities by utilizing your lifetime capital gains exemption of up to $813,000. Also, you're able to capture the growth of Can Energy as well as Econ by still maintaining 10% in Can Energy, and as well receive dividends through the shares that you still own in Can Energy. And finally, to retain some control in Can Energy by maintaining 10% of control. So let's take a look at what the structure looks like. So Grace, you will still be owning 10% of CAN Energy, at which point you will sell 90% to ECAN. And by this new corporate structure, you will be able to achieve excellence as well as capture the best of both worlds. Why? Because you'll be able to tap into those large government contracts, but also maintain those loyal customers and employees that you have through CAN Energy. Now that we have covered how you're going to sell your business and how much you should sell, let's take a look at some of your personal considerations that you had mentioned earlier. We had taken a look at your employment contract, and it is a very attractive offer you have received. But we do want you to be mindful of a few details, such as negotiating, your ability to negotiate with your employer vacation time as well as free parking spaces. By negotiating vacation time, you'll be able to have more time for the things that you're able or you want to spend time doing. As well, you mentioned how you've worked those long hours, and so by negotiating a nice vacation time with your employer, this may help you with getting some rest. We also recommend for car allowances is to ask your employer about reimbursements, 50 cents per kilometer. By doing this, you're able to save to at least $10,000 in taxable benefits. This is because by using a company car, you would be incurring a significant amount of taxable benefits that you would have to pay. Now, we also recommend that in the future, bonus should be paid as dividends, and this is because you can utilize your dividend tax credit. Now, so we recommend to move to Ontario, and now when you're moving to Ontario, that means that you're going to have to sell your house in Alberta, and which may accrue significant capital gains. And so to avoid this, we recommend to use your principal residency. And utilizing your principal residency will allow for you to save at least $30,000 in capital gains. Now, once you're thinking about moving, you also want to think about those moving expenses that are associated with moving to Ontario. We want you to be mindful of the fact that you are able to deduct your meals, your hotel expenses, as well as your gas or airplane rides. And lastly, once you have reached Ontario, you might be thinking about purchasing a new property to stay in. And so we recommend to talk to your employer to apply for an employee loan that will allow for you to pay a 1% prescribed rate on this loan. And this will allow for you to save an interest of up to $15,000 each year for 10 years. And the reason why this is really great for you to apply for is because our estimations from outside have said 4%, and by applying for an employee loan, you will be paying a prescribed rate of 1%. And now pass it on to Shan to talk more about our recommendations and summary.
Thank you, Misha. So there was 3 issues we started the presentation off with today. The first, partnership or ownership. Now we're recommending to have ECAN purchase CAN Energy and run it as a subsidiary or a separate division for the West Coast. Next, in terms of the sale of CAN Energy, we recommend to sell 90% of the shares to maximize your lifetime capital gains exemption, as well to ensure that you are still able to receive dividends from the company. And lastly, for personal tax planning, utilize the moving expenses, the employee home loan, the car allowances, anything in the income tax act that we can maximize, we have thought of, and to do this to help minimize your taxes. And what is this going to do? With the subsidiary sale, will increase the connections between ECAN and CAN Energy, which are running very similar consulting businesses, and enable prosperity by, again, utilizing those capital gains exemptions, and ensure prosperity for many years to come. And as you may notice in our recommendation slide, we've been showing you how much taxes you may be potentially saving. And so there's a total tax savings of $233,000 just in 2016 once you have that sale. And there's also the savings that you can have each year on from the interest as well as the car allowance. Now, let's look at planning for retirement. So you are currently 45, we're thinking you're probably looking at retiring the next 20 years, and based on the contract information you provided from ECAN, your income will be about $280,000 in salary, and we're estimating about a bonus of 30%. So that's $80,000. And after taxes payable in Ontario, as well as living expenses of $138,000, you'll have a disposable income about $113,000 you can use on anything for living as well as saving for retirement, which is what we're going to focus on today. So currently you have an RRSP with $175,000, and from the information you have not yet opened a tax-free savings account. So let's talk a little bit about the tax-free savings. It's an account that you can put money in, and any income earned will be tax-free. However, the money you put in cannot reduce your income tax, unlike the RRSP where you get a deduction on that. And so from 2009, currently you have $51,000 of contribution room. So for RSP, we recommend to continue contributing as you have, but to increase that from $10,000 to $24,000 to maximize the maximum contribution rooms you have each year, and to maximize your TFSA each year. So we're going to max that out, and then following that, because it's 2016 and the Liberal government is in now, the TFSA is now $5,500, unfortunately, not $10,000. And you also will have additional money left over, so you can put that in non-registered accounts, and so that's the $83,000 there. And so with a calculation of a return on investment of 4%, in 20 years, your RSP will have a $1.66 million, TFSA of $282,000, and your non-registered will be at $2.52 million. So you have $4.47 million available for you upon retirement. That's a lot of money that you can use to buy a vacation home, maybe see the world, travel, as well as use into your retirement years. And so for implementation, for our big recommendation, you need to approach ECAN on the purchase opportunity that you would like to present to them. And we want this to be happen right away, so in January. And so Grace, you will be doing that. Next, once this is confirmed, you can negotiate your employee contract with ECAN for terms for the additional benefits such as the home loan, as well as the free parking and things like that. And so that can happen after the purchase has gone through. And next, to contact a financial advisor to discuss investments with higher yields. So we noticed that some of your investments in the RSP is earning 0.8%, 0.5%, and we think your money can do much better than that. So contact a financial advisor, see what options there are. There are potentially lots of bond funds that are earning rates of about the 4% that we've estimated. So we think that's something you should definitely look into. And next, once the two contracts for the 5-year contracts that you looked at go through in September, we want you to contact your lawyers and to set up that sale to ECAN. And so the lawyer fees, we think, for that contract, we think will be about $4,000. And next, you want to be ready to move to Ontario. So you want to list your Alberta home for sale, claim the principal residence on that, as well as look into the condo you can buy in Ontario. And lastly, before the December, we want to ensure that you keep proper documentation of your moving expenses so that we can claim that in your personal tax return. And so one last thing is, in April in 2017, when you file your 2015 personal tax return, to ensure that we will be helping you report the sale of CanEnergy shares to utilize your lifetime capital gains exemption, as well as claiming the principal residence and anything else. So that will be done by us, thankfully, and then it's about $2,000 for that tax return. Now there are a few issues that we've come up with our recommendations that we want to address. The first is, what if ECAN is not interested in purchasing CanEnergy? The likelihood may be medium because right now they're just thinking of acquiring you because you're the biggest asset of the company. However, and the impact would be high, obviously, because then you would have to look into selling your company to a third party or consider maybe not being employed at ECAN. However, we want to, in that case, you would want to look into passing CAN Energy to a current capable employee, and hopefully within that time between now and moving to ECAN, you can train them up so that they are prepared to take on the company. The next one we've addressed is if the September consulting contracts fall through. So there's a 50% chance those do not go as planned, and the likelihood is medium because it's 50%, and the impact would be medium as it would affect the assessment of the fair market value of your company. However, we think a sale with CAN Energy to ECAN is still possible because this sale will be beneficial for both of you, even if you do not secure the contracts, because with the additional resources, as well as your skills and your employee skills, we think there will be many potential to acquire future contracts. And so to conclude, Grace, today, a few days ago you walked in, you had two issues in mind. Should I stay and expand the business in CAN Energy, or should I move on and discover other business opportunities with ECAN? And today our recommendation shows that you can really have the best of both worlds by selling your company to CAN Energy and running it separately as a subsidiary. And also we looked at your personal considerations and ensure that you're well taken care of into your retirement. Thank you for your time, and we'll like to answer any of your questions.
All right, thank you, competitors. Judges, you may ask any questions you may have.
It looks like a good plan. The fact that I'm only gonna own 10%, is there something that I should consider in negotiation? I'm not gonna control anymore, and now, what if I hate where I'm working? What if this doesn't work, working for this partnership, and I only own 10%, I don't like the direction they're taking my company? Is there something that I could do in my negotiations that I could back out of this, or?
So I think there will be important negotiations to put in, discussions with ECAN to get a feel for their working style and their work culture, first of all. Next, you can consider in your contracts to maybe have an exit clause, maybe have a pending, 1 year, if things don't work out, maybe something like that, yes.
I'm wondering, how does your recommendation improve on the work-life balance that Grace is really seeking to change? Besides just having, vacation once a year, is there something else with this new opportunity that she'll be experiencing truly on a more regular basis? If you can elaborate.
Sure. So by selling 90% of CAN Energy to ECAN, what is happening here is that she's able to reduce her work hours also by incorporating more employees, because now ECAN will have also CAN Energy. So she's not like the sole person responsible for any customer complaints. There will be other employees to help her out with that. As you mentioned, how that is an issue.
I think your analysis sort of suggested that I could get that $900,000, which was sort of the number that was bandied about in the earlier conversations. Currently, my business earns $5,000 a year, and I'm wondering if a smart company like ECAN is going to pay me $900,000 for an investment that makes them $5,000 a year.
Okay, sure. To answer your question, the business income of the CAN Energy would be $120,000 if you do not include the salaries you pay yourself. So there's that. But also, we think this future sales do depend on your ability to get those two very coveted contracts that you've mentioned. And so, yes, it will depend on those two contracts.
Do you think that what I do there isn't worth anything? Like the company could run without me, so that 120 could stay, or do you think that someone else is going to have to pay a manager to run it?
We think the most likely candidate, as well as the best candidate to run the company after it has been acquired, will be you. However, as we have mentioned, you do have the support of many partners at Econ, so you won't have to put in quite as many hours or quite as much work into that company after it has been acquired. I hope that answered your question.
Kind of, I'm just saying, further to his question, I guess, it's not $120,000 that my company's making, because whether I'm there or not, someone has to manage the company, right?
Yeah, correct. You're absolutely correct on that.
So if they want me so bad, why don't I just tell them to reimburse me all my moving expenses? Why do I care about deducting them? Why wouldn't I just tell them, if you're gonna make me move to Toronto, I want you to pay everything? And you didn't mention that I like when I sell my house, I have to pay some realtor an astronomical amount of money for that. Do I get to claim that, or should I ask for that too? Is that a legitimate moving expense? I mean, all that other moving expense pales in comparison to that expense.
To answer your question, you will be able to deduct that expense on the sale of your house. So any realtor fee will be deductible to you, and you can claim that deduction in your personal tax return in the coming year. But, and also to further answer your question, why don't we just have the company pay all the expenses? And that is because some of the expenses that they pay for will incur much larger tax liabilities on you than others. And so we're only recommending you to claim expenses such as oil, meals, as well as hotel fees, so that you can take advantage of the provisions in the Income Tax Act and minimize your taxes.
And that's all the time we have for questions, so thank you, competitors.